Hi, my name is Lee Thurburn, and I'd like to thank you for joining us as we do a recap of our first 2 years of business. My wife and I started our Turo business, Jubilee Auto Rentals, at the first week of, actually right at December 1st of 2022. And so 2023 was our first full year, and 2024, of course, therefore, was our second. And we learned a lot, as any entrepreneur does, over the course of the first couple of years. And I'd like to share some of the more important lessons with you. So first, here's a quick recap of the vehicles that we had in 2023. So what you see on screen with the earnings that are reflected there are the vehicles that we had. Most of those we acquired during the first 9 months, 8 months, right up through the first part of middle of August of that year. And we took the approach, following the advice of a lot of people that do Turo advice videos on YouTube. We took the advice of buying cars that were 7, 8, 10 years old, 12 years old, and cost anywhere between about $4,000 and $7,000 and $7,500. And on average, we probably put $1,000 to $1,500 in each vehicle to bring them up to standards so that they could be safely and reliably rented on Turo. But of course, not all the cars ended up being good cars. And before I get into kind of the history of the vehicles, I do want to stop and mention that during the first year, we decided to be on the 75-25 protection plan. And as you know, that means that there's a $500 deductible when a vehicle has an accident or some sort of damage while it's on a trip. And that's an important thing to keep in mind because, you know, you don't know what you don't know. And what you don't know when you're starting Turo is what kind of damages you're going to have, what the reality of the business is going to be like. So not only did we choose to buy inexpensive vehicles, but we also chose to be on the 75-25 program. Now, our revenue, this is a printout from Turo of our 2023 earnings. You can see right at $51,000. This shows a couple of interesting things. During the first 8 months of the year up through August, as we were adding vehicles, of course, on average, our revenue was increasing, corresponding to the number of vehicles that we had added. But then, as you'll see, it tailed off. Well, the reason is that in the first to the middle of September, the National Highway Transportation Safety Administration issued a recall notice on about 3.5 million Hyundai vehicles. And of our vehicle list, of 4 of the 12 vehicles that we had were on the, were on that recall list. Now, before I move on, I want to mention again that we were on the 75-25 program, and just so you'll see what that means, if we had been on the 90-10 protection plan program, instead of $51,000, we'd have earned a little over $61,000, which would have been about a $10,200 increase in our earnings that year. So that's kind of an important point to keep in mind. Now, back to the Hyundai recall notice. These 4 vehicles that are in red were caught by the recall notice. And so we did not earn anything on those 4 vehicles the last 3.5 months of the year. As it turns out, Hyundai did not mention or announce when they would have the fix kit available for the dealers. And so in January, not hearing anything from Hyundai, we decided to go ahead and sell off those 4 cars and reinvest the proceeds into other vehicles that were not under a recall notice. That leads us to year 2, 2024, and what happened in that year. So let's start by a quick recap of the earnings report from Turo. You can see that we really doubled our income, our earnings, from $51,000 to $102,000. And that occurred for a number of reasons. First of all, because instead of 8 out of 12 vehicles being able to generate revenue, we began putting vehicles into play that could generate more revenues. Now, I'm going to take a quick look at the vehicles that we had during the year. Not all of these vehicles stayed with us. We had 4 Jettas, which are shown at the top, that were carryover from 2023. We had also a Volkswagen Tiguan, which is the 5th vehicle down, that was a vehicle that we had in service until about April or May of 2024, when it blew a valve on its cylinder head. We then purchased 3 vehicles, a Ford Focus, a Chevy Cruze, and a Dodge Caravan, a 2013 Dodge Caravan, 2012 Focus, and a 2014 Chevy Cruze. I'm going to tell you that story here in just a second, but I want to also show you that starting with the 2019 Dodge Caravan, the vehicles that are shown below are shown in the sequence in which they were acquired during the year. The Chevy Tahoe was purchased the Dodge Caravan was purchased in mid to late January, so it had about 11 months of revenue, but we did have a problem. I'll tell you about that in a second. The Chevy Tahoe was purchased at the end of March, so that is 9 months worth of revenue for the Tahoe. The 2016 Suburban was purchased, I think it was at the end of April, so it only had May through the end of the year, so that would be 8 months worth of revenue. The 17 Suburban and the 19 Suburban were both purchased in late May, so they came into service in June. And then the 18 Tahoe and the 14 Suburban were purchased at the beginning of August. And so they only really had about 4.5 or 5 months worth of revenue generation. But what I want to do is I want to talk about the problems that we had. So I'm going to start with the 2011 Tiguan. That vehicle blew an engine in April, and we ended up having to sell it as junk because the repair would have been way more. We would have sunk more in the car than the repair was worth. But more importantly, the car was getting up in miles. Even though the interior and the exterior were in great condition, the exterior was beginning to show wear, a few little bumps and bruises, and we decided not to invest in it. We did get about $1,400 for that, which we were happy with. The Ford Focus, we paid about $4,000 for, and in the course of about 2 to 3 months that we were trying to have it in place, earning revenue, we spent $4,000 on repairs. They never seemed to end. The car was just a problem. It generated about $500 in revenues, and we ended up selling the car for $4,000. So we got our money back out of it, but we did put $4,000 worth of repairs into it. So that was a $4,000 expensive mistake. The Chevy Cruze, again, we paid about $4,000 for, and this vehicle, while all of our vehicles, we do Carfax reports. I drive them to see how they feel. I run a scan tool on them to see if there's any, codes or hidden information that comes up. And the car passed all that inspection. Seemed like a good car. Took it directly to the mechanic. I always take cars to a mechanic after I buy them, so that some basic, upgrades can be done. We put about $1,700 into it, and one of the things the mechanic was supposed to do was fix an oil leak in the oil cover on the cylinder head. There was a leak around the gasket. Well, that turned out to be directly related to a bolt that held the gasket into the head, and that bolt would not firmly hold. It had been stripped, and so unfortunately, as the mechanic began to drill down and try to fix that issue, just additional expense after expense after expense started incurring. And aside from the $1,700 that we spent on things like tires and brakes and other things, it ended up being a multi-$1,000 repair. We ended up having to sue the mechanic, and that relationship, of course, is gone. And that's why we ended up with legal expenses this year that had not been in case the previous year. That car ended up being basically a complete write-off, and so we ended up spending $6,000 on a car or more that never generated a bit of revenue for us. So that car was a really bad mistake. The 2013 Dodge Caravan seemed like a good investment. The car drove great. There were no check engine. There were no issues on the scan tool. It did show that the car was from Massachusetts, and I saw that there was a little bit of rust on it, but I did not realize how pervasively acidic and caustic rust can be and what kind of damage it can do under a car. This was a 10, 11-year-old car that we bought, and that was enough time for rust to be able to really do a number on all the connections and the parts underneath the car. And so we ended up, even though it was a beautiful car and initially drove great, and every time we'd fix it, it would drive great, but there would be repair after repair after repair. So that car ended up being real expensive, and we ended up selling it off, not getting our full money back for the vehicle, and having spent about $5,000 on repairs. That was a real problem. And then we get to the 2019 Dodge Caravan. The 2019 Dodge Caravan was the first vehicle this year that we decided to go ahead and bite the bullet, incur debt, and get cars that were both newer and low miles. So 2019 Dodge Caravan, as it's certainly the newest car that we at that point had in our fleet, and it only had 62,000 miles on it. What we did not realize, and you're never going to know this, is that about 15,000 miles later in July, while it was on a guest vacation trip, the transmission dropped out. I don't mean fell off out of the car, but the transmission quit working. Well, we had the car towed. Ended up being a 3-month ordeal to find, to make decisions and check things out. But we ended up spending $6,000 with the dealer to fix that car, along with a couple of other issues that the car had that were relatively expensive. That was a $10,000 repair job on that vehicle, not for just the transmission. The transmission was $6,000. But the point is that car ended up being a boondoggle. Now, we still have it. It's a very popular car. It's going to make we think it's going to make its money back. But we were very, very disappointed that 2019 Dodge Caravan with only 62,000 miles, 75,000 at the point that it dropped its transmission, or the transmission broke, would be such a disappointment. I mean, it's just a disappointment completely all the way around. The rest of the vehicles, the Chevys, they are great vehicles, and we have a good story to tell on that. So let's take a quick look at the comparison. I'm going to show you a chart of our timeline of earnings. These charts have been adjusted and scaled so that the $10,000 per month line I have drawn through the middle corresponds on both of them, so you can sort of see what the revenue looks like. Obviously, January and February of 2024 did not see a big increase because we really had issues getting rid of vehicles, or with the vehicles and spending money. Bottom line is we didn't start to see real revenue increases until March, and it was in April when the Tahoe began to start generating revenue. So by the time we get into May and June, we're adding Suburbans. And of course, we get into, in June and July, we get into the summer vacation months, and we have a $13,000 month in July, which we would also have had in August, except for the fact that we had a vacation that we'd already planned for August and really didn't want to change that. Well, my wife and I run the business, and if we're on vacation, that means cars can't be moved, they can't be prepped, they can't be checked in, they can't be checked out, all that kind of stuff. And so we had a good decline in our revenue. August would have been around a $13,000 a month if we had not had the vacation impact hit us. September came back up a little bit, and then we're into the little bit slower season of the year, which is just the way things worked out. but that's why you see the fluctuation that you see. So next, what I want to do is I want to start talking about the analytics. I'm a very numbers-oriented person. I began my professional career as an accountant, became a CPA, started my own CPA firm, and then went on and did other things. But at the beginning of 2024, I decided to create my own accounting software. I have been using QuickBooks, but really found it to be a problem generating the kind of data presentations and tracking of basically P&L statements per vehicle that I wanted to see. And so I created my own software package called carfleettools.com. And now I know it's a little difficult to see this, but this is a list of the, for the year 2024, the P&L statements. This is actually sort of just the top part showing revenue and variable costs. So it's operating income, 3 lines of operating income, and then the operating cost of goods sold, which are things like, batteries, brake repairs, and, brake repairs and just general repairs and oil changes and toll fees and all that kind of stuff. And so these are the things that we decided we wanted to try to track on a per vehicle basis. Toll fees we actually didn't. But the point is that each one of these columns represents a vehicle. Now, this column right here where you see the cursor shows the Dodge Caravan. And the Dodge Caravan had revenue of $6,900 during the year. It had an expense of $10,121 for a couple of big repairs, $6,000 for a transmission, and then there were a couple of other fairly significant things that that needed to be done. We had a motor that dropped, and the entire gear in the window had to be replaced. So it was an expensive vehicle. The net cash flow on that vehicle was a negative $6,200. So that vehicle was responsible for $10,000 worth of repairs for the year. Now, this last column over here is a total for all of the other vehicles. That's not the same as the total for the company because there are vehicles that I sold during the year. Now, before I get to that, I want to show you the general P&L or income statement for the company so that you can get a better sense of what kind of presentation and information you should have, I now have, on a monthly basis and more frequently if I want to generate it. So it starts with operating income. Now there could be other types of income, so we separate out operating income. That's damage claims, reimbursements, and rental income. You can see it shows $111,000 for the year with $107,000 for rental income. Now you may be thinking that doesn't seem to sync up with $102,000 shown on the earnings report. And that's because there's a difference in how Turo accounts for revenue versus how bottom line is it's a timing difference, if you will. So just set that aside for the moment. Cost of goods sold shows detail for things like brake repairs. If I wanted to track depreciation, which I don't, I would show that. There's fuel, there's insurance, there's interest, there's miscellaneous fees. These are all the fees that are operating income expense items that we track. And you'll see that total operating cost of goods sold was $100,000. Now, as we go to the next line down, I want to click on that. This shows total operating cost of goods sold, operating gross profit. That's basically contribution to cash, contribution to other expenses. Here are the other expenses. They're operating expenses, different from cost of goods sold. And these are for things like bank fees and office supplies and, software and telephone and utilities and all that kind of stuff. And then you have net operating income, which then is followed by other income and other expenses for a total net income. Now, the two main things I want to show you under other income and other expenses would be vehicle sales, because if you're in this business long enough, you're going to have some vehicles that you sell, and you don't want that revenue skewing your monthly financials or the data on your business. You want to be able to separate your operating income and expenses from your other income and expenses. So we show vehicle sales as well as asset write-off, which is vehicles that we're writing off as an expense. Then you have net other income and then your net income. And I just blank those out because that data isn't really particularly significant. So now I want to take and give you a little bit closer look. Some of these numbers you hopefully will be able to see. I pulled out a report for just the Volkswagen Jettas. These, of course, are very similar cars. They're all Jettas. And I wanted to show you some what I think are interesting bits of information here. So the Volkswagen Jetta, $9,400, $7,400, $7,400, $7,600, $32,000 in total revenue. So here's what's kind of the interesting thing to look at. These Jettas, by the way, were all paid cash sometime during the first part of 2023. So they're generating nice positive cash flow. But the expenses on them are beginning to become pretty significant. So we have $3,000, $2,996, $2,900, only $485, almost $3,250, for a total of $9,600 in expenses. So $32,000 in revenues, $9,600 in expenses, basically about 1/3. These cars are generating positive cash flow, but they're also aging. All of these cars are really getting into the one of the vehicles the lowest has about 125,000 miles on it. The other is 165,000 miles. They're beginning to get a little long in the tooth. This 2013, which I'm hovering over right here, on about December 27th or 28th, was on a long distance trip to Mississippi, and right at the Louisiana-Mississippi state line, the driver pulled off to get gas, and the car wouldn't start because the engine had basically blown the valves, one or two valves in the head, and it had to be towed back. That car is going to cost $3,200 to get rebuilt, and it's not worth it. So I'm going to end up selling that car as a junker here this next week. But the point that I'm bringing up here is that while all of these cars are generating positive cash, I've now had 3 Volkswagens with engines in the 160,000 plus or minus mileage range, and that have basically had to have engines replaced, and I've had to break the car. So I'm going to sell these cars off, and I'm going to add other vehicles to our fleet. So I just wanted to show you how some data could be looked at here. Now, I next want to show you some data on the vehicles that have been sold in the first 3 months of 2024. These are vehicles, actually the TIG one was about 4 months in, but here's the TIG one, generated $6,900 for the year. Even before the $3,000, $4,000 repair job on the cylinder head would have been paid, it had $3,200 worth of repairs. And so even though it generated $6,900 worth of revenue in about 4 months, it also only netted about $3,200. Still not bad, but, obviously an asset that should have been worth, $5,000 was sold for $1,400 because it had a blown engine. Mazda CX-7, which is a vehicle that we had in the first year, this vehicle ended up having some leaks in it, and so oil leaks, and they look like they might be severe, and I got estimates on them, just didn't want to spend the money. So we sold this vehicle before it ended up becoming a repair nightmare for us. Honda Genesis, we spent a lot of money on it the first year on repairs, had already decided to sell it, sold it about the first week of January. This is the 2013 Dodge Caravan. It generated about $3,900 in revenues during the about 6 or 7 months that we had it. It also cost us about $7,000, primarily big repairs, $5,000, but it cost us $7,000 in general to maintain this car. during that time frame. So it was a net cash flow loss of about $3,300. And then we had, excuse me, jumping around. Then we had the Ford Focus, $4,000 in repairs. Bought the car for $4,000, put $4,000 in repairs into it, sold it for $4,000, and made about $500, $600 in revenue off of it. That was, of course, a $4,000 cash flow loss because of all the repairs. The Chevy Cruze, we had bought that car for $4,000. We were able to get about $1,000 for it, so net $3,000. It never generated any revenue, and we had $1,700 that we put into that car. So that car ended up costing us about $4,700. So it doesn't take too many of those kinds of cars to end up really causing you to have a pretty sour cash flow situation. That's the bad news. Here's the good news. Here's our Chevys. Now we have bought, and all of these cars are bought, we finance these cars. There's a 2019 Tahoe, a 2016 Suburban, a 2017 Suburban, a 2019 Suburban, a 2014 Suburban, and a 2018 Tahoe. So that's going across. And this, like the Chevy Tahoe was bought at the end of March, and so we only have 9 months worth of revenue, $13,700 in 9 months. We have 8 months worth of revenue for this car. We have 7 months and 7 months and about 5 months, 5 months and 5 months. So these cars were added to our fleet primarily over the late spring, early summer, and they generated a lot of revenue, really good revenue generators during the summer. Now, what I want to show you is the total for all these cars. They generated $48,000 worth of revenue. There was only about $7,000 worth of repairs. And we do have insurance and interest expenses on these cars, but here's what's the important thing. These cars generated almost $25,500 worth of gross profit, which is positive cash flow to help cover expenses that the company has. And that's a 52% gross profit margin, which is good, but it can be a little bit better. But the point is that a 53% gross profit margin with strong positive cash flow and very low repairs is exactly where you want to be in the car rental business. So what are the lessons that we've learned? Well, the first thing I want to say is it's become very obvious. You've seen this from other YouTube Turo trainers and influencers. Repairs will eat your lunch. So you want to buy higher quality vehicles. Now, when we started in this business, we didn't know what we didn't know. And of course, everybody's in that boat to begin with. And so we took the cautious approach of buying cars that cost $5,000, $6,000, maybe $7,000, put $1,000 into them, and then just repair them along the way. Well, generally that would have worked, but there were a lot of repairs. And so we've decided it's better to have a fewer number of quality cars than a higher number of lower quality cars. And so what are quality cars? Well, certainly we think that the Chevy Suburbans and Tahoes. Now, not all Chevys are great cars, but all of the research that I've done basically says that the Chevy Suburban and the Tahoe are cars that you should easily get 200,000. Generally, you should expect to be able to get 200,000 miles out of the car, and with proper care might get 250 to 300,000 before they need significant mechanical issues that'll need a repair. That's kind of the same thing on Toyotas, but that goes pretty much all Toyotas, you can say the same thing about. Toyota Camrys and RAV4s would be great vehicles. Toyota does make vehicles that have CVT transmissions. I would stay away from those. Honda has a great reputation for quality. CRVs, RAV4s, these are the kinds of cars I would focus attention on because people generally prefer SUVs. And the SUVs will generally rent for a little bit more money than a sedan will rent for. And SUVs can be used by people on vacation in the summer months, which make them very popular, and they're going to go for a premium during those kinds of time frames. The next thing I'd like to talk about, sort of lesson number 2, is that you're going to hear a lot of people tell you that you should not finance cars. Well, at the end of the first year of financing, that's the best decision that we've made in quite a while. We've got really good vehicles, and they are generating way more revenue than they are costing us in the way of insurance and payments. We do, of course, have one problem, child car, that is the Dodge Caravan, the 2019 Dodge Caravan. But I'm going to recommend you stay away from all Dodge Jeep products because they do not have a reputation for high quality, whereas the other vehicles, the Toyota, the Honda, and the big SUVs in the Chevy family are cars that people that you can depend upon. Be sure that you get larger, better vehicles, more late model cars. And when it comes to colors, we've discovered that black SUVs are best. They rent the fastest, they rent the highest price. White's a good color and they do well, but I certainly would prefer to stay with black, and I certainly think I would avoid the bright colors like silvers and blues and reds and things like that. People like those classic looking SUVs. Lesson number 3, bigger is better. Larger SUVs attract a higher quality client. They are less likely to be abused. They're going to be returned on average in better condition, and they rent for more money, especially during the summertime. So I would definitely go with larger cars. Now the next lesson, it regards the protection programs. So in 2023, we had damage claims of $14,975, say $15,000. The actual cost to repair the damage, I'm going to estimate, I didn't track it as well as I now will in the future, but I'm going to estimate it was about $8,000 to actually repair those cars. One vehicle was a 2013 Hyundai Elantra that had hail damage, and we received about $3,500 for that vehicle in compensation from Turo. And of course, you can't fix a car with hail damage, so we just kept the money and rented the car out with hail damage, and it rented fine, but it ended up being sold because of the issue with the safety recall. But if you do the math, we ended up making a repair or damage claim profit of about $7,000. Now, if we had been on the 90% protection plan, we would not have received very much of that $15,000. We'd probably received, maybe $1,500, $2,000. I'm not sure, but we would not have received much because of the way the different programs work. But if we had been on the 90% protection program, we would have had $10,200 in increased revenue because of the difference between the payouts, the earnings on the two programs. That would have been offset by the $8,000 in damage repairs, because we still would have had the damages, so we'd have had a net cash flow from repairs or damage of about $2,000 as opposed to $7,000. So we definitely came out better by being on the 75-25 plan than we would have being on the 90-10 plan in year number 1. But we were on the 75-25, so we did pretty good. Now we're on the 90-10 plan. So in 2024, we received damage claims reimbursements of about $2,500. The cost to repair that damage was about $1,500, so we came out ahead about $1,000. Now, we didn't have nearly as much damage in 2024 because we had a much more valuable and expensive, and we had a better class, better car, better clientele, so just not nearly as much damage. Interestingly, our revenues by being on the 90-10 program in 2024 were $17,000 higher than they would have been if we'd been on the 75-25 program. So we definitely made the right decision for 2024 by switching to the 90-10 protection plan. So what is the upshot of all of this? Well, the upshot of all of this is basically, if for your bigger cars, you're going to have typically lower damage claims. I would put the bigger cars on the 90% protection plan, and I think I would put my smaller cars on the 75% protection plan if I were you. Now, we have all of our cars on the 90-10 plan, and we're going to be making some pretty significant changes to our fleet. We're going to be selling off the Jettas, using that cash to go ahead and buy some, probably some Toyotas and Hondas, and maybe another Tahoe or Suburban. Basically, we're going to be continuing to add higher quality vehicles, SUVs, to our fleet going forward. So here's bullet point or lesson number 5. Over the course of 2024, as I've been utilizing, testing, improving the accounting software of carfleettools.com, I have gotten progressively better information about our fleet and how things are going. And I'd like to invite you to go to carfleettools.com, sign up for a free 30-day trial. That does include telephone support. It's an inexpensive software. It's only $12.42 per month when you annually prepay, or just $20 a month after the 30 days. Look, this is much, much easier for you to use than QuickBooks. It is incredibly simple to get up and running. It's designed specifically for Turo hosts. You can be up and running literally in minutes. You can import your data from your bank, whatever bank you're dealing with. You can have unlimited bank accounts, but bottom line is it's really easy to import the data and then to assign expenses to cars and revenue to cars and generate reports that'll allow you to have a nearly real-time view of how your fleet is doing, how your cars are doing, and you'll be able to make intelligent decisions about your fleet. What vehicles should you keep? What vehicles should you change? What kind of strategies should you have? How should you tweak your strategies? All that kind of stuff will be apparent to you with the reporting processes that are available to you at carfleettools.com. So thank you for watching. If you have not already liked this video, please do so. If you have not yet subscribed, please do that. And give CarFleet Tools a try. I think you're going to really like it, and it's going to help you run your business, and you're going to make more money as a result. Thanks for watching, and I'll have more videos coming soon.